Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of XTB and you're watching our weekly trading webinar. So today we are going to discuss about record inflation in the US and impact on the Fed policies and the markets obviously. But before we do that, let's start with what's really hot on the markets right now. So even on Friday afternoon, markets were discussing mostly the Fed and the impact of this inflation on stocks, on the euro dollar, but we were shocked by the information from US intelligence that Russia had already decided that there will be an invasion on Ukraine, and therefore we already saw a stark reaction on Friday afternoon when, as you can see, especially on the Russian RTS index, which has a symbol RUS50, we had a strong plunge in quotations. At the same time, oil prices surged higher. So obviously this is a very unfortunate situation even for me to discuss, because we'd love to talk about economic growth, interest rates, corporate earnings, things like this, not about the war. This very sad situation. However, investors have to deal with anything, what's any kind of news, and even us as fortunate and sad as this one. So right now the situation is that the market is basically waiting, a little bit nervous, a little bit scared what could happen, but not in the full panic mode. As you can see here, this RUS50, it's still higher than it was towards the end of January, when there was previous kind of tension in this relationship. Then the market recovered, and then it fell on Friday. And today, I would say it's relatively calm, right? I mean, it's opened in the proximity of the Friday's close, of the lows. So yeah, I mean, there is no continuation of the panic. And also, if you look at the global markets, they are relatively calm. Of course, the Nasdaq, it's subdued. As recently as beginning of February, it was above 15k. Now it's 1k lower, but it's still off the lows from January, and there is no further sell-off on today's morning. So I would say markets are waiting, and from that point, it really can go both ways in terms of this impact of this geopolitical situation on the markets. Because on one hand, yes, with Putin, you never know what his thinking is. I think he's already well embedded into it. So unfortunately, a situation, a scenario of a quick compromise, withdrawal from all of this seems to be unlikely to me. Yeah, because obviously he's deep into it, and unless he has some strong result for his internal image, it's unlikely that he simply withdraws. So I think it's going to be dragged probably for quite a while. The question is, however, if there is going to be invasion or not in the near term. Because if it is, so obviously in the immediate reaction we would see further market nervousness, probably with oil prices. You can see these oil prices, they were already on the up even before this thing, because the market's tight. The OPEC is in no rush to add extra supply, and then, the economy is maybe not doing great, but it's relatively strong right now. So that's enough to propel prices higher. We are already way above the pre-Omicron levels. And obviously, market is concerned about the implications of any conflict on logistics, and therefore oil prices are storming higher. So in the event of invasion, of course, there will be further reaction. Probably in the near term, we could see prices above 100. The other markets to watch is gold. Obviously, gold usually does well in situations of uncertainty, but here actually our focus would be more on platinum, and especially palladium, where Russia is the #1 exporter in this crucial metal for the automotive industry, which is also precious metal, by the way. As you can see here, in the second half of January, when this conflict started to become more likely, palladium prices increased quite sharply, and in the event of any sanctions, we could see this having an impact on further price increases here. So, yeah, and finally, last but not least, Russian ruble. It's also the pair where you could see reactions, especially that, market, of course, there is a move, right? But, it's still lower than it was, let's say, in late 2020, where there was no issue at all from this geopolitical point of view. So, yeah, I would say markets are a bit, nervous, but it's definitely not full-blown panic yet. So if there is invasion this week, as suggested by U.S. intelligence and as denied by Russian officials, there will be further reactions. If it's not, then I think markets will take it as a positive, because yes, there can be a scenario of prolonged tension where Russians try to create a threat to gain some significant political concessions. However, for markets, it's for as long as we don't get the worst scenario, it's a good scenario. So this is the way I'll be looking at this. All right, let's move on to the main point of our presentation today, which is inflation in the US, which was 7.5% in January, which is another 40-year record. And importantly, it's not temporary, as the Fed used to say, and yeah, they lied, obviously. We said that a year ago that their inflation was a problem. It wasn't about to be temporary, and yes, we were right. As you can see here, it spilled over to other categories. So obviously, fuels and cars, yes, it contributes, keeps contributing to inflation levels. However, the other parts of inflation are becoming more and more important. So this is a problem, and the Fed needs to act. And yeah, there are some methodological changes, and they're coming live in May. So the first inflation in using new methodology will be for April. And if this inflation methodology would be already in place right now, the inflation in the US would be even higher. So that confirms that this is a problem. Now, from the market point of view, it's a bit tricky because, as you can see here, from the interest rate perspective, already 2 hikes, which is 50 basis point move, seems to be fully priced for March, which I would say it's perhaps some kind of exaggeration because, of course, the Fed, yeah, they said we are going to tighten policy, we are going to rise interest rates, we are going to start shrinking our balance sheet. It's all fine. However, 50-point basis move could be seen by some as too strong signal for the markets, and they may want to avoid this. Even if they hike each meeting, they could prefer avoid 50 basis point move, not to signal too much on the front end. And therefore, because the market seems to be pricing this fully already or nearly fully, you would say, okay, maybe markets move too far, and maybe from a point of view of euro dollar, where there were already some problems with this trend continuation. As you can see, we saw plenty of rebounds attempts. Yeah, it's still downward trend, but yeah, we are at the level which was also there in November, when the Fed was still way before talking interest rate hikes. So yeah, there are already issues with the downward trend here. And you could say, yeah, also for stocks which are somewhat off the top, it's still obviously, if you look at the whole bull market, it's nothing. But yeah, it's still the part of the largest and longest lasting correction in a long time. So you could say, okay, maybe Fed only rises by 25 basis points, and we can see weaker dollar and stronger equities. It is possible. However, also bear in mind that there is a liquidity situation, because right now the Fed still prints money. Even though there are talk about significant tightening, until the the mid-March, or I don't know, 10th of March, they are still printing, and that means that there's a lot of money on the market. As you can see here by the reverse repo, the Fed needs to sterilize the markets by $1.5 trillion each day. This is going to change, especially in the second half of the year, where we're going to see Federal Reserve shrinking their balance sheet if they actually commit to do what they say they will. And at the same time, we're going to have Treasury issuing bonds because, well, they still have deficit to cover. So over the past 2 years, the Treasury, they were able to finance really lofty spending without really taking money from the market, because they had the Fed delivering it. Especially in the second quarter of 2020, it was crazy. They printed crazy amounts of money, more than the Treasury actually needed at the time. So for 2 years, there was even though we had deficit, there was tons of money on the market because the Fed, pretty much provided the whole financing for U.S. Treasury. But that's changing right now already, and it's going to change, especially in the second half of the year. So like I said, from the market it's a bit tricky, because on one hand you'd say, well, these expectations are already too sharp. On the other hand, when this happens, there could be, if there is no liquidity in the market, things can get awry very quickly. And yeah, that's going to be interesting to see. Finally, before we move once again to indices, a quick review of a situation from '94, when the Fed also delivered significant tightening, and they actually even increased interest rates or between the meetings. They met between the regular meetings, and they said, okay, we need to hike again because the inflation risk is there. So, but you can see that on the S&P 500, also the Nasdaq, the correction was only before this first rate hike and this surprise intermeeting hike, and afterwards, actually the market started to bottom out. So many hope that, okay, maybe that means that also today it's not going to be that bad. However, bear in mind that back then, during this inter-hike meeting, PE for S&P 500 was already down to 15, whereas today it's 26. So obviously equities are much more expensive today, and we will need to see some correction before we could say, yes, it's safe bet that these rates are no longer a threat for the market. So from my point of view, is like, yeah, markets could be expecting too much from the Fed too quickly. However, we are yet to see a significant market scare. It wasn't here. It was just a small correction from after a huge rally. Yeah. Also, if you look at the DAX, it managed to defend this 14.8k, 15k support zone on multiple occasions, and I think only breaking below, clearing the stops here. Maybe some combination with this political situation. We are yet to see a real kind of panic, which would clear this market a little bit after this huge rally fueled by the policy, which is no longer going to be there. So in the medium term, I'm keeping an eye on this zone where a potential correction could lead us. All right, moving on and sticking with inflation. Also, keep in mind that it's not just stimulus, it's not just oil, but also food prices that are getting more expensive, adding to these inflation risks. If you look at oil prices around the world, they are surging. If you look at soybean prices, which is connected because soybean is crucial for soybean oil, it's going up. So it's also an issue, but something which you could use to kind of play this inflation game. Because if you look at soft prices, they are in huge rallies. Coffee up from around 100 in late 2020 to 250 right now. Soybean up from around 900 to 1600 these days. cotton up from, let's say, around 60 to 120, more than 100%. So yeah, so we have these commodities adding to the rally as well. All right, last but not least, the earnings season is nearly over, and generally it's been very upbeat. So that's a positive. If you look at the equities, especially U.S. equities, the earnings are there. If you look at here, this blue line, it's EPS 12-month forward. So that means that shows what kind of results are expected from S&P 500 companies over the next 4 quarters. And importantly, it keeps increasing, right? So so you could say, okay, earnings are not an issue. They're definitely supportive for the market. And that means that even after this relatively benign correction, the price to earnings, forward price to earnings, is down from around 20 to 23 to around 20. So that's a positive. Companies which could be struggling are the COVID stars that are not necessarily producing big results. Lyft, Uber last week, and also this German delivery hero. It's really interesting case, because as you can see on the chart, it's already below March 2020 levels. So it's incredible. It's not here. No, it's not this one. Here we are. So yeah, as you can see, the stock, it was around 140, right now it's 40, even though it's the results for last year were slightly better than expected, but because the markets were too hot about the prospect of this COVID stars, we are now coming back to earth, and these companies that are not making money in the environment of higher interest rates, they are going to be under pressure. This week we are going to have some more of the results. However, the big picture is already there. The season was strong, and it's not going to change. The biggest names this week are Nvidia, definitely. Then we have Shopify also. We have Palantir Technologies, retail investors' favorite on Thursday. But yeah, like I said, overall, the picture is there. Otherwise, we're going to have couple of calendar events like FOMC minutes on Wednesday, US PPI on Tuesday, UK inflation on Wednesday. So few publications definitely worth watching. We are going to discuss them in the news section, so please make sure to you track it. However, for now, definitely the under in the spotlight there is this geopolitical situation and anything Russia could do. So full focus on this, especially during this beginning of the week, which is not so intensive in the calendar anyway. So yeah, we are going to report it for you in the news section, and thank you for your attention. We're going to see each other next Monday, 7:30 a.m. Have a great week. Bye.